Budgeting is such a very important tool for managers. Every organization, profit and nonprofit, government, all organizations budget. It forces managers to plan for the future. In this lecture, we are going to look at how we develop the master budget.
And after studying this chapter, you should be able to identify the benefits of budgeting, state the essentials of effective budgeting, identify the components of a master budget. All of this, of course, is leading to a projected pro forma income statement at the end of next year. So to begin with, a budget is a formal written statement of management's plans for a specific time period, usually a year, and this statement is expressed in financial terms, and it's a way to communicate among managers across the company. It promotes efficiency, as each manager knows what the other one is doing and therefore will not duplicate any activities. And once the budget is prepared, it then becomes a way of evaluating performance, so it's a control device. Now, to prepare for a budget, we need a lot of historical data, and therefore we involve the accountant in developing that data, and we get past revenues, costs, and expenses. And the benefits of budgeting, from senior management's point of view, of course, is that it requires all managers at all different levels to plan ahead. And it provides definite objectives for evaluating performance on those managers. The budget also is an early warning system. Are we going off track here? What do we have to do to get back on track? Another great benefit is it's a coordination of activities, so we don't duplicate activities across it. Promote efficiency. It also makes managers aware of what the other managers are doing in the company, and of course, a well-functioning budget promotes and motivates personnel throughout the organization. Now, effective budgeting depends on sound organizational structure and a lot of research and analysis. Now, the length of a budget period is generally a year for operations. We break that down into monthly or quarterly, and that's long enough so that we can judge whether we're attaining the goals. There's seasonal and cyclical fluctuations of activity and so on. But the budgeting process starts with sales. And the sales forecast is very important, and therefore we spend a lot of time on it. We analyze general economic conditions, industry trends, market research, a lot of market research studies. We analyze how much we expect to spend in advertising promotion. We look at our market share. We look at any price changes or technological developments that may affect our estimates. And we must be aware that we are involving human behavior here. So each level of management has to participate in this. And it depends on how the budget is budgeted. And that is called participative budgeting. Now, the advantages is that we get more accurate budget estimates because the lower level managers are closer to the market and therefore have more detailed knowledge. This process then is perceived by them to be fair because it involved them. They are making the estimates. They're putting their name to their predictions. Okay. And we want to make sure that everybody feels that it is fair and achievable. Compared to a top-down budget where management says, okay, this is the sales we want you to achieve next year. You produce and sell to that. That's a top-down budget. It's not perceived to be as fair. But the disadvantages of participative budgeting, as you may well find out, is very time-consuming. There'll be meetings after meetings. The budget process starts 3 to 4 months before the budget year, and therefore there'll be a lot of meetings between September and January 1st, which would be the start of the budget year, for example. There's also a possibility that managers will game the system. Now, senior management is always looking at this. And that means what they're looking at is the fact that managers understand that they're going to be evaluated based on their estimates, so they will lowball their estimates. They will say, instead of sales of 10,000 next quarter, I'm going to say 9,500. So senior management's looking for that. And that could be very disastrous because everybody else produces to that estimate of 9,500. Or if the sales are 10,000, we have some problems. So there we have the lower management, the department managed levels. It all feeds to the plant manager, up to the vice president of production, up to the president. Now these budgets, when they're all put together, they're interrelated and they're referred to as the master budget. Now there are two types, and we're going to focus here on the operating budget. That's the individual budgets that result in the preparation of a budgeted income statement. The other budget is called a financial budget, and that is the subject of the next module, and that would be a cash budget, and that leads to a budgeted budgeted balance sheet, So the master budget then starts with the sales budget. Now the production manager takes the sales budget and develops a production budget. Then the purchasing manager takes the production budget and purchases the direct materials. The production manager produces the direct labor budget. The accountant will do the manufacturing overhead budget. Those are your three cost elements: direct material, direct labor, and overhead. Then the marketing department and administrative department will put together a selling and admin budget, and then we move to the budgeted income statement. From that, we can produce what's called a budget. With that, we can produce a budgeted income statement. Then there's the cash budget, which leads to a budgeted balance sheet. Now, the sales budget is very important. It's the first budget prepared. It's the best estimate of sales revenue for the budget period. All other budgets are based on the sales budget. For example, here we have Hayes Company. Expected sales volume, 3,000 units per quarter, 500 increase in each quarter. $60 selling price. So the sales budget is straightforward. 3,000 first quarter, 35 second quarter, and so on. And I have a total budgeted sales of 900,000 for the year. Now the production budget is a little more complicated. The production manager must produce not only to sales, but in case sales is out, we also produce to a desired ending inventory amount. Now, inventory, from management's point of view, is a buffer in case we overestimate or underestimate the sales. We have already desired ending inventory. So management will establish a policy that the ending inventory must be a certain percentage of what they need in the next month or the next quarter. But because that policy is consistent, we already started this quarter with ending finished goods of the last quarter. So they become the beginning finished goods of this quarter. An example will illustrate this better. Here we have the sales budget, 3,000 quarter one, quarter two, 3,500. Now, from production point of view, in quarter one, I need to produce to 3,000 for sales. Plus, as it says here, management wants 20% of next month's sales as ending inventory in this quarter. So next month's sales is 3,500. So therefore, I must produce 700 in quarter one to meet the requirement of 20% of quarter two sales. So in total, I need 3,700 in quarter one, but I don't have to produce 3,700 because I ending inventory the year before is the beginning inventory in this quarter, and that would have been 20% of 3,000 or 600. So I produced a 3,100. Now in the second quarter, you notice 3,500 plus 20% of 4,000. But the 700, which is ending inventory in quarter one, is a beginning inventory in quarter two. And so I do not have to produce those 700, so I need 3,600 to meet those requirements in quarter two. And that's how the production budget is put together. Now, the direct material budget is the same thing. The manager there must make sure they purchase enough raw materials or direct materials to meet the production budget Plus, we need a buffer here as well, an inventory, a desired ending inventory of direct materials, but I already have a beginning inventory as we did before. So again, let's assume for purchasing budget, we have to have 10% of next quarter's production requirements, okay? Now each unit requires 2 pounds of raw material, and the expected cost is $4 per pound. Assume that the desired ending material amount to 120 the year before. Prepare the master budget. So we base this on production. So from the production budget, first quarter is 3,100 units, second quarter 3,600. Now I need 2 pounds for every unit I produce, so therefore I need 6,200 pounds in quarter one, 7,200 in quarter two, 82 and 92. But I also have to have 10% of what I need next quarter. So 10% of 7,200 is 720. So I produced a 6,920, but I already have 10% of this quarter, which is 620. And I produce the units I need to purchase units of 6,300. Now, when you do this budget, do it in units. Don't do it in dollars. On the last line, convert it to dollars. Cost per pound, $4. And I get my budgeted purchase, $25,002, $29,200, and so on. So that's my direct material. My direct labor is a little more straightforward. Units to produce times the amount of labor time per unit times the cost. So I go back to my production budget again, 3,100 units, 2 hours, $10, and I get my total direct labor budget done. Now, the overhead budget, generally done by the accountant, is broken into variable costs and fixed costs. Now, it's manufacturing overhead, the third cost element. So the variable costs are related to the production units, and we distinguish between fixed and variable. So in Hayes Company, the variable costs fluctuate with production volume on the basis of the following rate: indirect materials $1, indirect labor $1.40, utilities $40, and maintenance $20. And so therefore, as you can see down below, from the production budget, first quarter we're doing 6,200 units, so the variable cost 6,200 times the dollar, 6,200 times $1.40 for indirect labor, 6,200 times 40, 6,200 by 20, and I develop the first quarter variable costs. Fixed costs are given, and they will remain the same across all 4 quarters. So in the second quarter, the production is 7,200 units, so I build the variable costs. And I get my third cost element, the manufacturing overhead budget. The selling and admin budget, similar, are your period costs here. The overhead budget was your product cost. Your period costs are also broken into variable and fixed. Now the variable vary with sales. Okay, so we've analyzed this, and the sales commissions vary with $3 per every unit sold, $1 for freight out. And with that, down below I have then the production or the budgeted sales in units, and I multiply the variable costs. Sales 3,000, $3 per unit, 9,000, and so on. So you can see how Excel has been a great benefit to doing all of these budgets. And I develop my selling and administration budget, and with that now I can develop my budgeted income statement. I can look at what my expected profitability of operations will be in the future. And I simply take the budgets. There's one thing I have to do, though, is determine the cost of goods sold, the direct material, direct labor, and manufacturing overhead. Those budgets were produced on production, but the cost of goods sold is related to sales. So therefore, I look in what's the unit? Well, the unit of a cost of goods sold is $8 material, 20 labor, 16 overhead, so it's $44. And during the year, I sold 15,000 units, so the cost of goods sold is $660. So now I can proceed to do my forecasted income statement. From the sales budget, I have $900,000 in sales. I've just calculated the cost of goods sold to be $44 per unit, so therefore $660 the cost of goods sold. Gross profit $340, selling them in $180. Income from operations $60,000. Now we also find out that interest expense will be 100 and income tax expense will be 12,000, and in that way I have developed my projected income statement for the following year. You bastard.